Hi everyone, this is Tim. I'm going to go through a review of the housing market here in the spring of 2020. I'm looking at the national economy real quick. We pretty much all know it's been bad, so I'm not going to waste a lot of time on that. We are going to look at the national market, looking at both new construction and existing homes. I'm going to look at Massachusetts, where most of us are concerned about. Looking again, I have one slide on new construction and a bunch on the existing housing market. So let's tear right into this. So the first thing that we want to tell is this is basically an inventory story. You can see that the ratio of housing units, that's both apartments and condos and houses and everywhere you could possibly live, to households. So this has always been over 100%, meaning there's always more houses or more housing units than there are households. So there's some slack in there. And what we see ever since the recovery here is that we are just continually going down, down, down. This ratio goes down, down, down. And that's been the story for the last 10 years. All right, so real quick, let's take a look here at the COVID economy that we find ourselves in. The one thing that I'm using to track this in a general sense is this weekly economic index. And this is put out by the New York Federal Reserve. And you can see on the right here, they have all of the data series that they follow, and these are weekly items, and you want to look at weekly so you have a good idea of what's happening currently, as opposed to most reports are monthly or even quarterly, and that just doesn't tell you enough when everything's changing so quickly. So here's what they use. They throw it all into some formula, and it spits out a four-quarter GDP growth rate. In this case, it's been negative for quite some time, a couple months anyways. And so what I did is you can download this chart and throw it into a graph here. I'm sorry, this graph, and throw it into a chart. And this is the weekly change, right? From 143 to 0.95, then 0.95 to 136. And then I also did the last of each month, and that's the monthly change, we'll call that. So they don't have a neat, end of the month read. It's just a weekly read. So this 17% negative was from 12/28/19 to 1/25/2020. And things got slightly better in February, and then everything fell off a cliff in March, continued to decline in April, coming back up for May, and we'll see what June brings. It looks like it is steadily somewhat improving. You can see that here we sank way down. We're coming back up, and you can also see that in the long view how much more severe this is than the last recession in 2008, 2009. All right, so continuous claims are the second, third, fourth, fifth times you file for your weekly unemployment claim. We peaked at 17.1% on 5/9, currently at 13.4 for the week ending 6/13, which was last week. And that's an improvement over the week prior at 13.9. So things are going in the right direction. The U6 unemployment level is just a broader measure of people who want a full-time job and can't get one. They have to work, multiple jobs because they can't find that full-time job that they want. So the U6 level went from 6.9% in January, and it pretty much held pretty much steady there. And it spiked up to 22.8% in April, and then dropped back down to 21.2% in May. So here's April, here's May. And I think we're all expecting that this to continue to drop down for June as folks start to get back to work. Okay, so now the total unemployment level in the nation is 29.5, which is a peak down from the peak of 31 million. When you look at the state claims, and then this is the pandemic unemployment assistance, for the seasonal sort of gig workers. We're tracking that as well here. One thing to note, though, is we don't really know how many unemployed people there are because 6 states have not even yet started processing their PUA claims. And we have another 16 states who have not processed any of the emergency unemployment compensation. So once these states actually catch up, we'll have to go back and take a look at these. Hopefully they get updated with the most current information so we can see actually where we're at. So how is this affecting mortgages? Mortgages in forbearance ticked up. You can see my sort of running tally here. Peaked at 855 on 6/7, and last week we ticked down a little bit, which is good news. And this is an April chart. Don't have the latest info for this. Still waiting for May to come out. Black Knight's a big data provider, but everything's just kind of slow. But one thing to point out is you can see that the loan to value, this is where the bulk of the action is. All right, so then mortgage delinquencies. Just have a Q1 read, unfortunately, which was up 0.5% over Q4 2019, sitting at 436. I do have more information from Black Knight. This is for May, and they're saying their data is showing a delinquency rate of 7.76. So that's quite an increase, and it shows here the month and the yearly increase. You can also see these numbers of properties 30 days past due, 90 days past due are all going up pretty significantly. So we're going to see what happens with that. Hopefully things start to fall back down, but it's really hard to say. So this is still the April information. One thing to note is the rapidity. We went from 3 to 6 in like 2 months. And it took us, I don't know, a couple years to get there during the last recession, which was a housing recession. And one thing to note over here, I'm sorry, and this shows, so this percent here, this is this giant 3.1% increase. I'm assuming June's going to be bad as well. So 645 is the national rate. If you carry that over, the two lowest rungs on the housing tier by property value are the ones suffering the most. And then here you just have pre-COVID delinquencies are 1.4, post are 2.2, and you can see the difference here. 30-year mortgage rates are certainly going down with the Fed pumping all kinds of trillions of dollars into all of the markets, including the housing market with mortgage-backed security purchases. So we are at the low end. We ticked up a little bit from May, but not a big concern. And if you look at the long run chart, ever since the 80s, we've come all the way down, down, down. It just keeps going down, and it looks like it's going to stay here for a while. I didn't put up here, but the Fed has said they're going to keep their target rate at 0 to 0.5% through 2022. And here's just a quote that grabbed some headlines on 6/10 during some of his conferences. He said, "We're not thinking about raising rates. We're not even thinking about raising rates. So low rates are here to stay for the foreseeable future." Okay, here's a quick review, past history of pandemics in Europe. We have a lot of data from Europe since 1314 in the Black Plague. This was put out by San Francisco Federal Reserve members. I did put the link down here. I recommend everyone who is interested in this sort of thing grabs it. It's 16 pages, and honestly half of it you can skip because it's all math formulas, and yeah, I don't need to get into that. So a couple of observations. Real wages went up, right, due to deaths or sick people not even being able to work anymore. And you also see that interest rates go down. You know, they might tick up a little bit, but they go down. Now that we have the advent of central banking, it's really hard to say how that's going to change things. We're already at a super low rate I guess if you think that this is going to continue, then we're looking at negative rates, a decade or two out. And just a couple of conclusions here that they made. Pandemics are followed by sustained periods, talking decades, with depressed investment opportunities, either due to excess capital per unit of surviving labor and or heightened desires to save, possibly due to an increase in precautionary saving or rebuilding of depleted wealth. If real low rates are sustained for multiple decades, that will be good for governments to mitigate the consequences, because we have to borrow a lot of money to make up for budget gaps. And we're going to talk about budgets in a later with local and state and even federal governments. One caveat they do put in here is the Black Death and other plagues hit populations with the great mass of the age pyramid below 60, so our populations are much different. And it's really hard to say exactly how this specific pandemic is going to play out compared to the others. Okay, single-family new home construction. New home construction sets the market, so that's why you want to know. So your new homes, short of historic homes or noteworthy homes, are going to set the market for just commodity houses in general. So mortgage applications are the leading indicators. We have mortgage applications were down in April 12% over April 2019, and we are up 10.9% this for May over May 2019. We'll see what June brings, but it's looking like that is a positive trend. We'll see what happens. Okay, so single family construction sold. April, not surprising, was down 12%. And here is these are annual rates. These aren't the actual numbers, these are annual rates. So we definitely dropped here, and then May everything bounced back 12% from 600 to 676 over May 2019. And here is your chart. Here's May, April, right? We bounced back up. And here's a longer view. This is a 5-year chart going back 2015. And just sort of trying to find the channel where the bulk of the price action is. If anyone's ever bought and sold the stock, you've probably done this analysis with the stock because you want to buy it, if you get below the trend and come back in. But the point is, sometimes you go over, sometimes you go under. As long as you sort of revert to this rising channel, you're happy. And that seems to be what's happening. Here's a 10-year chart, same story. And we're right back at the bottom of this rising channel. So as long as we can come back in here and keep going up, we're looking good. And this is just a much longer view chart, so you can see where the possibility is. I think we had a big overbuilt here, and then we crashed down during the last recession. And we'll see where we're at, but really we never got back to where the price action is, sort of in this middle. We barely got back here before we're crashing out. So new construction statistics, you're looking at housing starts in blue, and red is permits. For, again, looking at single family houses. So starts were flat month over month. Permits did get pulled, but look how far off we are from where we've been over the past 5 years. Everything just fell off a cliff. And this is the long view chart. Again, if you look up here, a lot of this price action's in the 800 to 1.2. And we didn't get back to that till the past couple of years, which is, leading to the housing crunch. And then here's just another picture of housing starts. See, we were trending above 2019 for the past few months, and then April, May, we're trending well below 2019. Okay, so median prices. April, they fell. down to 303 versus 339 in 2019. So that's a big chunk down. And then we came back up for May, rose 1.6%. May over May, 2019 at 317.9 versus 312.700 for the May 2019 price. And what happened is home builders reduced prices. So in May, 22% of home builders reduced prices. In June, 15% of home builders reduced prices, and each by 5%. And just by way of comparison, they throw in, the last housing downturn, you had 52 and 49% of home builders decreasing prices by 7 and 8%. And here's just another chart showing what they did. They reduced, offered upgrades, pay your closing costs, reduce the price, help you sell your existing home, offer, upgrades for your energy, that sort of thing, and so on. Okay, new construction median months on market is rising. 2019, we ranged 3 to 3.6 months. May was 3.8. April was 3.3. So that's a pretty good tick up. Here it is on the graph. So we're already outside of 2019 range. And down here is just a long view. I mean, this went almost 14%, give or take, during the height of the last recession. So things are moving still relatively quickly. Let's see if we can even bounce above 5. And that would probably start a new trend of increasing months on the market. Okay, so USA existing single-family houses. Mortgage applications, again, the leading indicator, are up 13% versus 6/5/2019 and 15% higher than the previous week. So this was as of June 10. And you see here's 2020 on a stacked chart. We had been doing much better than all of these previous years. It fell off a cliff. Here comes COVID, and now we're coming back. And hopefully that continues. So existing single-family price. Sales price was up 7.42% from April 2019, and May was up 2.5% over May 2019. And what's interesting, and this has never really happened, is you can see that we had percent change from April to May of every year has, for the past 20, since 1999, has always increased, sometimes by more, sometimes by less, but never less than 1% increase. And you can see it here, and you can see this negative here. And that does not bode well for prices. If the month to month, which has always been positive, went down. Not by a lot, but it went down. Okay, so transactions are pretty much falling off a cliff. We were down 17% over April 2019, and we're down 26.5% over May 2019. So that is accelerating decline. But you can see here that this is not 100% unprecedented. We've been here before, but this was in the height of the recession. Hopefully these numbers at least level off, and if not, even tick back up. Okay, and the problem is partially due to new listings. We're down 44% over April and down 29.5% over May. So here's the drop, here's the comeback. Hopefully these keep coming back and that trend continues up. All right, and existing days on the market. We are 6% longer for April, and May checks in at 26% longer. then May 2019. And here's the chart. I drew some sort of trend analysis. It's always a U shape. You have a U shape, you have a U shape, and this is a pretty sharp V is what I'm trying to show here. And that's going the wrong way. That should level out and then start going back up with the season. So something's happening there. Okay, month supply. And I have the definition here. And we are up very sharply from these lows in February. We had been very low. And we're up 11.5% over May 2019. So this is going up, up, up. Month supply, we're up 4.8%. 6% is considered neutral, so we're still in a seller's market. If we switch longer than 6 months, we'll switch to what's considered a buyer's market. All right, so that's enough of national. Let's talk about the Great Bay State. Just looking at where everybody is, our inventory is very low. So we have a vacancy rate for single-family homes in Massachusetts at 0.9%, and for the nation it's 1.4%. And our rental vacancy rate, if you're thinking about rentals, Massachusetts in blue, somewhere around 3.5 or so, 3.7, and the nation as a whole is somewhere around 6.5, 6.75. So basically Massachusetts is pretty much full. There's not a whole lot of places to go. Okay, so we start talking about Massachusetts economy, and we want to really take a hard look at what happened with COVID. So what I did is I pulled the income. This is income by thousands of dollars. We want to look at non-farm earnings, 2013, years 2018, 2019. So what I did to sort of see how big these sectors of the economy are is I took the 2019 earnings, right, income, and divided that by the non-farm earnings, and I came up with these percents in this column here, percent of 2019. This is in the yellow column, so it totals 100%. And these are some other columns, just the change from 2013 to 2019. Again, this is income, the 5-year average, and then the change from 2018 to 2019 to sort of compare against that 5-year average. I don't know how much value is people are going to find in that sort of information, but I thought it was interesting to look at. So we want to look at, in red, the economists sort of labeled what are the sectors of the economy that are, quote, at risk, due to COVID. So they identified trade, both wholesale, retail. They identified arts, entertainment, recreation, and accommodation and food services. This is as far as what's being shut down. I would argue that you could also include construction, and I'll show you why in a minute. So if you just take the at-risk total of the red, is 13% of the earnings for Massachusetts. If you add in construction, it's 19% of the earnings in Massachusetts for 2019. And then what I did over here is I took the peak number of employees. So we're off of income. Now we're on employees. In this part, I try to make a big box around it to differentiate, and the colors are slightly different up here in blue. So this is the number of employees, and this is the peak in January, February, March. Then I have the April employees. This is the percent change from peak. And then I took the May employees. This is the May change from peak. And then this is the monthly change from April, May to April. I'm sorry, April to May. All right, so if that still makes sense and I haven't lost everybody. So this is the change from April, or I'm sorry, from peak to April. You see construction lost 35%, wholesale trade lost 15%, retail trade 21%, and these are the big ones. Arts and entertainment and recreation lost 67% of the employees, and accommodation and food service 63% of the employees. And then May change from peak, 24% of the employees, which month over month is a 16% gain, so that snapped back pretty nicely. Still want to see this number come up. Trade, not a whole lot changed, 12% and 20%. It's a very small bounce back for May. Looking to get some of these doing better. Arts and entertainment sunk even more from 67 to 72, which is a 14% decline, and accommodation and food services sunk. It actually improved from 63 to 58, and that's a 13% decline. I wasn't done with that. So we are somewhat better, 3% and 5%, depending on how you want to count. If you just want to look at the red with the industry experts, or if you want to include me with construction. We did bounce back some, but not a whole heck of a lot. Okay, so initial unemployment claims, this is pretty much what we've just shown. It's been bad. We're at 30,000. We're at 30,400, so we are improving month to month. I'm sorry, even week to week, rather. But expect this to sort of zigzag around now that I think we're off of the peak. And continuous claims is also looking good. Not looking good, but going, at least trending in the right direction. We peaked at 16.8%. We're at 15.86, and last week we were at 16.2, so that's somewhat good news. We want to see this keep going down as more and more people get rehired. Okay, this slide I'm trying to measure demand. And this is a March figure. This is only updated every so often. But this is the best I got. So Boston, Cambridge, Newton was very hot at 91.14, which put us at 12 in the nation. And they're measuring hotness by median days on market compared to the national and compared to last year. And they're also just looking at the average number of clicks in the various communities. So Boston Metro is 12. Worcester is number 21. So that would slide in right here. So Massachusetts has number 12 and number 21, two of the top 21. And then we want to look at, there's a lot going on here. Let's just look at the picture for the moment. These are the counties that are hot and not. And so what we're seeing is a lot of urban flight. And there's a whole bunch of stories here that talk about it. Looking at the city of San Francisco, 72% of Redfin users looked outside the city in April 2020, which is up from 68% a year earlier. April and May, 27% of Redfin users outside their metropolitan area compared to 25% over April and May. And then you finally have page views of homes in towns with fewer than 50,000 residents were up 87% year over year in May, more than triple the 22% year over year increase with cities of 1 million or more. So people are definitely drawn to less populated areas. You have a Harris poll here. It said 39% of urban residents will consider a move to a less dense place, and 43% actually browsed on a website. And then here in May, suburban zip codes jumped 13%. which doubled the pace of urban areas. So it's a whole lot of data that all shows people want out of the big cities. So this is my one new construction slide that I have. Hopefully this gets updated in a couple of weeks for June, but we're down 46% over April 2019 at a seasonally adjusted rate of 323. And you can see Massachusetts never recovered. Just never recovered. We're somewhere around 1.2, and then we're heading between 400 and 800. Okay, now we're going to get into my graphs that most of you I think are more used to seeing. Just a quick note, MARealtor.com is the realtors, and they only do the MLS transactions. And the Warren Group does everything that's listed at the town registrar's offices. So you're looking at the MLS transactions, you're looking at off-market transfers, you're looking at family transfers for $1. It's everything. Everything that gets registered is scooped up by Warren Group. So the numbers are slightly different, but the trends are essentially the same. Okay, so this top graph is the month to month. Month to month, we were up 11%, 11.5%. In April, we were up 4.75%. Nope, I take that back. May, we were up 4.75%, and April, we were up 11.68%. If you look at the 12-month rolling average, which is the second chart on the bottom, May, we were up 5.23%, and April, we were up 5.14%. So that is starting to take off a little bit. We noted earlier on the national, I'm also going to point this out, and I didn't put together a graph for it, but the actual median price from April to May was minus $100. Went from $440 in April to $439.9 in May. So that does follow the national trend where we were down. It does not typically go down. I did look at every other April to May in this series that I have from 2015 has been up, because you're right in the heart of selling season. And this is just another picture with the same data. Up 4.74 in May and 11.68 in April. Oops, I forgot a percentage mark there. But the trend is still intact. You can see this was a pretty outsized gain in April as things really got shut down in Massachusetts. Okay, so closed sales, 3,712 in May, 3,441 in April. Just one thing to note, see, every spring, summer, we have a nice ramp up of sales. And then here came COVID and it went sideways, and now we're starting to go back up. Hopefully this uptrend continues. And again, same idea, 13% decline for April and 29% decline in May. These are pretty outsized declines. You have 10%, 20%, but I mean, man, we almost hit 30%. Okay, so 12-month rolling average. We are losing steam, 55,000 in April, 53.6 in May. You can see it really tail off. We're way down below the average trend line here. This is pointing down. And if this continues, we're going to keep pulling this down. And you're going to see this line start to get more and more steep. But man, we're all the way back at 2016 levels. Okay, so now here's the Warren Group, which is capturing the absolute positives. So April we were up 11.9 and down 11. I'm sorry, down 13% in closed sales. So this is median price for April, and this is closed sales for April. Okay, new listings for Massachusetts is obviously a big part of the inventory problem. They got cut in half for April and cut in a third for May. And again, if you can see the long chart here, every spring we go up into the summer, and that didn't happen. We have a big zig when it should have zagged. But it's good that we're starting to come off of this. Hopefully this continues to go up as people see housing prices continue to decline. It might pull people off the sidelines. Just on a 12-month rolling average here, you're down 10% over April 2019 and down 14% over May 2019. So things are trending down on a 12-month rolling average. And this is absolute inventory, down 28.5% over April and 36.5% over May. Here we are. This should be ticking back up, but it's not really. But we have been here before, not quite to this extent. If you look at the bottom chart, the year-over-year changes, you know, we are at a new low, but we've been around 35% before. Okay, and month supply is at 1.9 months. Again, 6 months is considered neutral. This trend line has been steadily going down for 5 years. All right, cumulative days on market. So we saw earlier in the national that this trend is starting to increase, whereas Massachusetts is definitely on the decline. We have gone from 72 to 60, which is a 16.67% decline for April, and we went from 60 to 53 in May, which is, you know, almost a 12% decline. So the blue line is the month-to-month gyrations. The yellow line is the 3-month rolling average. Try to smooth out some of these gyrations. And the red line is a 12-month rolling average, and they're all sort of starting to tick down. That really tells me that we're in a very hot market in Massachusetts. If we're seeing cumulative days on market go down. Cumulative days means the first time a house is listed for sale to the final pending status before it goes sold. So that means that period of time is compressing. Okay, now pending home sales, we have a new read coming out on Monday, but I wanted to get this out. That should be the last new read, I think, to update the series. For national, in April, we were down 21.8%. Massachusetts was down 38.2%. And then Massachusetts in May is down 7.6%. And the price is still going up, so that's a trending. That's a good sign. Okay, now here's the Case-Shiller, which is really the best method of looking at prices because median price can change based upon the mix of houses. So if you have a bunch of low-end houses that sell, it could skew the median price down. Likewise, if you have a bunch of high-end houses over millions of dollars sell, then that could skew the median price up. What the Case-Shiller does to try to get around these statistical anomalies is to look at the same house, the same exact house, same address selling over and over again, looking at the price differentials and trying to make sense out of all of that. So this is unfortunately a lagging indicator. We are still in March for this. We were up 4.8% from March 2019. And the month-to-month increase was up 1.5% from February to March. We'll keep watching this. Again, it is the best indicator, in my opinion, but it's also the slowest indicator. And just another big picture view. Since the recovery from the last recession, we have been outpacing the national, sometimes diverging more or less. It's a little bit tighter here. We definitely outpaced here, and we'll see how that trend continues to play out. It's not guaranteed. We obviously, we've been underneath, we've been over. We'll see how it goes. Okay, so with all of that, I'm trying to think of new sources of inventory to help with the inventory problem and hopefully mitigate prices. If you can get more houses on with the same number of buyers, right? Law of supply and demand says, well, less houses. I mean, less of a price increase. All right, so my first thought was sort of Airbnb. We're looking at just Boston has 3,500 listings. 63.5% of those are whole houses or apartments. And 73.4% of people have multiple listings. So if I am an Airbnb businessman and I have multiple houses that are available and I can't fill them because Airbnb is taking it pretty much on the chin as far as, bookings. And once all my government support runs out, so I'm a small businessman with an Airbnb business, I got, my PPP loans. I could have even gotten an economic disaster loan. The Small Business Administration has other loans that are available. But once all that money runs out, or if I continue to just see bookings are not happening, do I, one, convert my house into a traditional apartment, with a 12-month lease? Or do these owners, do these businessmen and women simply just say, listen, houses are an all-time median price, average. I should just cash out now while I can, as I am seeing some shaking in that median price if it's going to just continue to go up, up, up. That's one idea. Divorces, you have two-income families are now suddenly one-income families, and that might necessitate the sale of a house if that one-income person cannot support the household anymore. We do see evidence from Hong Kong that divorces were 21% higher, after the pandemic started to settle down and divorces actually got processed. So I think we can certainly say that divorces will go up, and that might be a source of houses. Foreclosures, we're going to continue to watch these delinquencies rise, and we'll see what happens once the government support ends. Some of these houses might get foreclosed on and thus scooped up. And unfortunately, we also have to talk about layoffs. The first wave was primarily low-income service jobs. And the new wave is going to be government jobs and corporate downsizing. In Massachusetts, this was an article on 6/19. 66 school districts sent out layoff notices to teachers and other educators, and they range from a few people to more than 100. And she noted 150 in Taunton. Some hard-hit areas were Weymouth, Medford, and Brookline. And looking at higher ed, the Federal Reserve Bank of Boston put this out. So the darker it is, the worse it is per county. You have two or more vulnerable, 2, 1, none, or no institutions. So Boston, it's kind of hard to see it. It's distorted here on the map. Obviously, they have a lot of colleges, so that's negative. Worcester has several colleges. That's negative. Amherst, Smith, the western states not the western states, the western counties, colleges. There's, Smith. There's a few of them out there, so those are also in danger. And you can see the regions of the rest of the New England. And if you want to talk about corporate layoffs, Fidelity shut its Marlboro office, moving most of its 1,100 jobs out of the state. Bank of America cut 3,500 jobs company-wide. Massachusetts will likely be affected. It's one of its largest centers of operation. Bank of New York Mellon employs 4,000 people. In Massachusetts, said it'll eliminate 1,500 positions. State Street said about 530 jobs will be eliminated over the next 18 to 20 months. And just bankruptcies, Chuck E. Cheese, GNC, Modell's, JCPenney, Pier 1, J. Crew, Neiman Marcus. These all have pretty big Massachusetts footprint. So that's it. Now you're smart. We'll do this again next month. If you have any questions, anything you want to talk to me about, you can shoot me an email or you can just post me on Facebook. That's all that I've gotten. Now I can figure out how to shut this thing off. There you go.